So, hello everyone, welcome to this session of the Wright podcast. In this session, we will be talking to people from one of India's largest AMCs, Axis AMC, and we will understand the concept of asset allocation from them. Asset allocation is a problem that we all need to tackle. Right? It is something that we all need in our portfolios, and it is important for us to understand it and understand it in simple terms. A lot of people watching this channel are new. They're new to financial concepts, and they require introduction to these concepts. And I think Niranjan is the perfect person here to talk about this. I'll introduce Niranjan first. Niranjan is a manager at Axis AMC. He has more than 18 years of experience in the financial services industry. He has a PGDBM in finance and he's a NISM certified trainer. He has conducted more than 40 CP sessions across India and he has more than 100 plus workshops on financial planning, goal-based planning, retirement planning across the country for mutual fund distributors and investors. He's conducted more than 100 sessions on equity, debt, macroeconomics, financial planning, for thousands of MFDs and sub-brokers. So I think Niranjan is the perfect person today to talk about these concepts, and it will be a very fruitful session for us to understand the concept of asset allocation with him. So Niranjan, welcome to the show. I hope you're having a good day.
Yes, Sonam, thank you, and a very good afternoon to everyone.
Yes. Yeah. So Niranjan, we want to understand asset allocation from you, right? Asset allocation is something that we hear about a lot, but it's a big term that not a lot of laymen will understand, right? So I wanted to simplify that for us, and we can take a simple example to build up. So I would request that if you could explain asset allocation with the example of cricket, right? Cricket is something that everybody understands, everybody plays, and they have understanding of. So how would you explain asset allocation with an example of cricket?
All right. So see, asset allocation is something where the aim of the investor or our aim should be minimizing risk, right?
Right.
See, why do we invest money? We invest money because we want returns, right? And what kind of returns? We need returns which are more than inflation so that it will help us to build wealth.
Right.
And to get higher returns, we will have to take some level of risk in our investments, right? That is the risk of maybe seeing negative returns in the short run.
Right.
But any investor, including me, right? We don't like to see losses in our portfolio. Nobody likes to see losses in their portfolios.
Yeah.
Right? But the thing is, when I'm investing in the capital markets, losses are bound to happen. But they're going to be only temporary short-term losses, right? Because if you see the history of our Indian equity markets or Indian capital markets, you have seen that over a 3-year, 5-year, 7, 10-year horizon, the investors who have been stayed invested in equities have always made better than inflation returns.
Right.
So how do I overcome this fear of losses? Because losses are a given fact. I will see losses in equity, say in the 6 months, 3 months, 6 months, maybe even 1 year, I will see zero returns in my portfolio, right? Equity portfolio. So how do I balance it out? Is by diversifying my investments, right?
Right.
So that is what asset allocation is basically all about. In asset allocation, what am I trying to do is I am trying to generate decent returns, but I'm also trying to manage the risk in my overall portfolio.
Right.
So if I have to give the example of cricket, right?
Yeah.
We all love cricket. Right now, we have seen the T20 is also happening, right? The World Cup, T20 World Cup for the Women's World Cup is happening. T20 is very exciting, right? I bat for 4 hours. Two teams bat for 4.5 hours. They hit sixes, fours, score at a very high strike rate. Right. And we have seen players who score even 50 in 10 balls, 60 in 20 balls, or 100 in 30, 40 balls, right? Very exciting and fun. But we've also seen that even the best cricketers in the world, India desire to score very fast runs, right? Get out at zero, right? So, right, look at T20. That is what it is, right? The best of players, we expect them to score 50s and 100s every time. But In a T20 match, if you see the number of people who have scored hundreds, even the best
Yeah.
of players are very few. Right? Why?
Right.
Because it's a very aggressive match. You have to go from ball one, start hitting sixes and fours. That is what even your equities are, right? Equities are what? I want very high returns. I want aggressive returns.
Right.
But the risk of equities is that in the short run, like how T20 is just a 20-over match. So in the short run, I might by luck hit sixes and fours, maybe score a 50. But then the probability of the batsman getting out at zero is also very high,
Right.
right? But look at a test match. A test match is like my equity investments. That is what an equity investment should be, right?
Right.
It should be for the long term. And
Yeah.
if I keep my investments for 3 years, 5 years, 7, 10 years, then the probability of getting out lower, right? I can score more runs.
Right.
Look at what is the highest test match score. Brian Lara has scored 401 runs in a test match, right?
Wow.
In a one day, we have got only 6 or 7 people who have scored more than 200 runs. But in a test match, you will see almost everyone, many people, the number of people scoring 200 in a test match is much, much higher.
Right.
Why? Because in test match, we have got time to play,
Yeah.
right? In test matches, I can play for say 80 overs, 90 overs, 100 overs. I don't have to hurry. I
Right.
can defend the ball, right?
Right.
And in a test match, it's also challenging, right? For example, look the India-Australia test series, which is just now happening, right?
Yeah.
We will think, look at the Indian pitches. It's a very spinning pitch, turning pitch. The batsmen have to apply a lot of mind, a lot of dedication, and it's a
Right.
tough place to play. That is what equity investments is all about.
Yes.
Equity investments is something where I have to take a lot of time, I have to be patient so that I can grow my wealth.
Right.
But the other thing is, today, why T20 is so popular? It's popular because it's exciting, fast cricket, right?
Yeah.
But test match is something which is played over 5 days. And people say, "Arey, 5 days is boring. I need some sort of excitement."
Right.
So that is where if you see a new breed of cricketers have also come, right? Who play that exciting form of cricket, but who are also there in the test matches, right? For example, the Indian team. Look at the
Right.
Indian opening batsman. You got somebody like a Rohit Sharma, who's a very aggressive player, right? Or a Shubham Gill, who's a very aggressive player. Virat Kohli is a very aggressive player in test matches. But along with them, we also have a batsman like a Cheteshwar Pujara or a Shreyas Iyer, who are what we call as a very conservative player.
Definitely.
Right? So that is what asset allocation is. I have got the aggressive side that is equities. I have got the conservative side that is debt.
Right.
So that what happens in equity, the aggressive batsman can score runs at a very fast pace.
Yes.
Whereas my conservative batsman will provide me the stability. Right? The aggressive batsmen know that I can hit fast. Even if I get out, I've got my conservative batsman who can stay put, hold one end of the fort, and the other end, the other aggressive batsmen go and hit out runs.
Right.
And that is what asset allocation should always be. That I have got one asset class which has the potential to score very quickly, which has the potential to give me good returns, high returns. But I should also have another asset class which provides me the safety, which provides me the stability. Right? If I am able to combine both in the long run and in the short run. See, in the short run, what happens, say I invest today. After 3-6 months, say the market's correct for whatever reason. Right? If I'm 100% in equity, I will see my full value get eroded, which will scare me and say, Baba, I'm not investing in equity, it's very risky. Right? So I shift to debt. But the problem is I stay invested in debt, say for 5 years, 7 years, 10 years, I will get stable returns. But the risk is that the returns I generate are lower than inflation. And I cannot create wealth. But in the short run, 1 month, 3 months, 6 months, 1 year, the chances of debt giving me zero returns, negative returns are relatively low, right? If I keep it in a safe investment in debt. So when I'm looking at my overall portfolio, the debt part of my asset allocation provides me that safety aspect or lower risk aspect in my portfolio, and the equities give me the higher returns in the long run. So I'm combining both to give me the perfect balanced portfolio, one of less risk, but stable returns, one of higher risk but potential higher returns.
Definitely.
So this is what asset allocation is all about.
Definitely. So if we were to give an example, equities is Virender Sehwag and your debt is Rahul Dravid, and you want to
Yes.
create a team that has both of these people, right?
Yes. So that is again, right? If you give the example, say Sehwag is very, very aggressive, Dravid is very
Mm,
conservative. See,
right.
the ideal would be the perfect combination of Sehwag, Dravid in one person, which is
Right.
not possible, right?
Yeah.
But in an asset allocation, I get both Virendra Sehwag and Rahul Dravid combined, which
Right.
gives me a relatively ideal portfolio.
Yeah. So they will cover
Right?
us in different places, right?
When my equity markets are doing well, I have got the equities which will do really good returns. When the
Hmm.
equity markets does not do well, because we know equity markets go in cycles, right? Few years they
Yes.
will do very well, few years they will not do well. So when they are
Hmm.
not doing well, my fixed income will provide me that stability. That asset allocation provides me that stability in the bad times,
Right.
right?
Right.
And yes, yes,
Perfect. So I think that's the perfect example, right? Asset allocation means a stronger cricket team by combining different types of
yes.
players. So I think that gives us a very good sense of asset allocation. I think a lot of us will understand the concept through this example. Now, will you give me a little bit more detail on how asset allocation adds value to our investment portfolio?
Definitely. So let me give another simple example, right?
Hmm.
Food. We all love to eat different varieties of food, right?
Yeah.
Say, for example, somebody asks, challenges you ki for one full day, eat only spicy food, or
Right.
for one day, eat only food which is very sweet. We won't
Right.
be able to do it, right?
Yeah.
Because too much spicy food will give us acidity and ulcers within no time. And if it is very sweet, also, we just lose interest and the taste. We don't feel like eating too much sweet,
Yeah.
right? So that is what asset allocation is. Simple thing. If I have only equity in my portfolio, then I will generate very, very high returns. But then when the
Hmm.
market corrects, I will sit on huge losses.
Right.
Same thing, if I keep all my money only in fixed income, then what will happen is
Hmm.
I will generate very decent returns, stable returns, but I will not be able to create wealth,
Right.
right? So I need to have such a portfolio. Our food is what? If I look at our food, I will
Hmm.
have food which is a bland, that is plain
Hmm.
rice. I will have
Yeah.
I will have a vegetable which is little spicy, maybe another
Yes.
vegetable which is less spicy, then a dal which is relatively plain, right?
Right.
When I combine all the four, a little spicy food, less spicy food, plain food together, and I eat, then you will see that the taste improves a lot, right?
Right. Right.
And or take the simple example of a thali. When you go to a
Yeah.
hotel and eat a thali, I've got a roti, I've got sabji. The roti is plain, the sabji is a little spicy. I've got a dal which is again little plain. I've got pickles which are salty, and I've got a sweet in the side.
Yeah.
And it is a colorful thali, right?
Yeah.
One vegetable will be green in color, another vegetable will be red in color, another maybe say the curry, the dal might be white in color, the rice will be white in color, another dal will be yellow in color, the sweet will be of a different color, right? I've got different colors, different tastes. And when
Right.
I eat that food, it gives me a sense of satisfaction and happiness. Though I've eaten such wonderful food, right?
Definitely.
The same thing with my investments also. When I'm giving different investments in my portfolio, so what
Hmm.
happens basically is I am looking to reduce the risk in my portfolio. See, as an investor, I've always wanted the highest returns,
Hmm.
right? We all want such investments which give us the highest returns, but in that process of selecting only returns, we ignore the risk part.
Yes.
And risk is something which is very important for us to manage, right?
Yes.
Because while chasing returns in a good market, when the markets are in the bull market, I feel very happy. Oh, the money is generating, I'm getting very good returns.
Right.
But the true test of my patience comes when the markets are not doing anything or then the markets are giving losses, equity markets, right?
Right.
And that is the time as an investor is how do I ensure that the losses are minimized?
Right.
I need to minimize. I cannot avoid losses in equities. I need to minimize the losses in equities.
Right.
And that is where my asset allocation will help me to reduce risk, right? So I have to look at asset allocation as a risk diversification or risk minimization technique, like my
Definitely.
thali. So
Yeah.
that is where asset allocation comes into play.
Yes. So while, a lot of new investors, they might be, only looking at equities, but, that means like they're only eating spicy food, whereas they need a balanced diet, right? For them
Yes,
to, have a sustainable long-term, good health, you need a balanced diet, and similarly, you need a mix of good assets, right?
yes, definitely.
Now, I have another question for you that, people in India, typically if you look at people, who are newly looking at the Indian market, or, who are new to investment
Hmm.
world, they typically, they start by looking at only gold, or, they think that, I have money, I'll buy a house, and, that's my investment, right? So gold and real
Okay.
estate is something that people look at typically, but what are the other asset classes where they can expand and, create a diversified portfolio?
Yes. See, we must differentiate between two things. One is my investments and my other is consumption. The
Right.
two asset classes we talked about, gold and real estate, right?
Yes.
People invest in real estate because they want to buy a house and stay in it. So that should not be considered as a part of my investments or asset
Right.
allocation, because
Right.
that is the house where I am going to stay, right? So if I have to look at real estate as an investment, it would be my second house, or a house from where I'm letting out, getting rentals. Maybe I will
Right.
sell it after a few years and a profit, right? But please understand, what is the quality of a good investment? A good investment, when I make, should be something where I can very easily buy it, I can very easily sell it, and I don't have to spend too much money in taking care of that asset,
Right.
right? So, but real estate does not fall under any of these three categories. If I have to buy a house, I have to search for the house. It will take 3 6 months to finalize the house, then I buy
Yeah.
it. If I want to sell the house, again, selling the house is not easy, right? It will take again 3 6 months for me to realize the money,
Right.
and to maintain the house takes a lot of cost.
Right.
So unless I'm buying the house for my own consumption where I'm going to stay, buying a second house is also expensive. Buying a house is quite expensive. It takes up nearly 40 to 50% of our incomes.
Right.
And in 99% of the people, they will buy a house with a loan,
Right.
right? So again, that we incur a liability to do it.
Yeah.
Second is gold. See, why do we traditionally buy gold? We buy gold because we feel it is very safe, it's very secure. And that is also a physical asset. I can touch, buy, feel.
Right.
But the thing with gold is, when I buy physical gold, there are two things. First, I don't know the quality of the gold,
Yeah.
right? Even if I know the quality, I have to pay an extra charge, hallmarking charges for the quality of the gold.
Right.
Second, after buying the gold, where will I store it? I can't keep it in my house, right? I have to buy a bank locker, open it, and keep it there. For that, again, I have to have charges.
Right.
Third, when I buy physical gold, there are charges involved in that gold also. It is not that I will get the price of market price of the gold. There will be some making charges, processing charges, handling charges which will be deducted. And
Right.
again, when I go to sell the gold, again there will be some charges deducted,
Yeah.
right? But we cannot ignore gold, because gold is used for various occasions, right? For functions in
Yeah.
marriages and all. So if I have to buy gold, one option now that is also available is called as gold through mutual funds, that is electronic gold, gold ETFs, or gold
Right.
savings fund, or we got sovereign
Yes.
gold bonds,
Yeah.
which is a better way to buy gold. So buy gold, but
Definitely.
please remember, gold, yes, gold will give me not more than 7 to 8% returns per annum in line with inflation.
Right.
So gold is not a wealth creator. Wealth creator in the medium to long run is equities only. Right? If you look
Yes.
historically in India, right? Historically, if India has now got a very good track record of almost 30 40 years of capital markets, right? If I look at that, inflation beating returns have been provided by equities only, right?
Right.
Second, equities I can enter in without much cost, I can exit out without much cost, like a mutual fund. What are the charges in a mutual fund? Very little. I can come in
Right.
anytime, I can get out anytime. Right?
Right.
There is liquidity in my equity mutual fund. I sell the equity mutual fund, I get the money in 2 days.
Right.
Right? It's very transparent. It's very liquid. I know what price I'm going to get. What is the value of my investment? Second, I don't want to take too much risk. My other
Right.
investment is a debt mutual fund, which provides me safety and decent returns. Right?
Yes.
So when I'm looking at asset classes, I must first look at creating a strong base. Right? It is like a house. When I'm building a house, right, I spend nearly 1 year in laying the foundation of the building,
Right.
right, which is going to be underground. Nobody's even going to see the foundation. But I spent nearly 1 year in laying the foundation. And once the foundation gets created, now it takes hardly 1 year to build a house, right? 1.5
Hmm.
years. So I spent
Right.
1 year building the foundation. So the foundation of my investments should be
Right.
something which is very safe, which is very secure, which is very liquid, and delivers decent returns. So as an
Yes.
asset allocation, my foundation should be safety and liquidity. That is fixed income.
Right.
Then returns, where it comes equities. Once I've created those portfolios and I have got enough wealth, then I can look at real estate as an investment. Right? See, again here, distinguish between real estate for as a house where I'm going to stay, real estate as an investment where I'm going to buy. They are completely
Yes.
different. So I should
Yes.
always look at equities and debt first, and then look at other asset classes.
Definitely. And well,
Yeah.
gold might have a play in hedging also, but like you rightly said, that a correct mix of asset is what really matters, right?
And yes,
Um,
gold is again an asset class which people use it for consumption. Right? See,
yes.
the problem here is when I buy gold. See, India historically we always have bought gold because it is considered to be easily transportable. Right? Suppose I want to transport 1 kilo gold, I can easily take it and go also instead of transporting 10, 20 lakh rupees. But please
Right.
understand gold as an asset class. Right? We are as Indians very emotionally attached to gold. Right? And we end up mostly buying gold in the form of jewelry.
Right.
And jewelry is something where almost say today I buy 10 grams of gold, it's costing me 50,000. I buy that equivalent jewelry, I'll end
Hmm.
up paying only 60,000 because making charges and all, right?
Yeah.
And there's a good chance I might not wear the jewelry at all,
Right.
right? So we are actually losing money when we are buying physical gold because of that making charges, storage charges, and all. So instead,
Definitely.
buy a gold savings fund or invest in a gold ETF. See, the advantage is what I am buying gold, but not in the physical form. I don't have to
Right.
bother about the quality of gold. I don't have to bother about the storage of gold. I don't have to bother about the prices of gold. Whenever
Right.
I feel like buying gold afterwards, I can
Hmm.
just redeem the money, take the money, buy the gold. Right?
Definitely. Yeah.
Second, I can buy gold in ETF or in physical in this one, DMAT, for as low as 500 rupees or 100 rupees also. I don't have to commit 5,000, 50,000 rupees.
Right. Right.
So that is the beauty of buying gold through the mutual fund route.
You guys obviously at Axis AMC do asset allocation in a number of your funds, right? So I
Yes.
would like to know is what type of factors do you consider while deciding asset allocation? So let's say you have to advise somebody, what factors will you consider to decide the asset allocation?
That access is in our hybrid fund category, right? We have
Hmm.
got this where hybrid funds per se, if you know, as per the rules, have to invest in multiple asset classes, right?
Right.
So here we have got a balanced advantage fund and a triple advantage fund.
Hmm.
Triple advantage is a multi-asset fund where it will invest in equity, debt, and gold, and the balanced advantage fund invest in a mix of equity and debt, right? So there again, like in my triple advantage, it is regulatory mandated that equities, debt, and gold. What is going to be my mix? Right?
Right.
We have got anywhere between 65 to 80% in equities, 10 to 20% in debt and gold. So this is where my triple advantage is there, right? And scientifically also, if you look at asset allocation, see, asset allocation is something which is again very unique to every individual person, right? So what holds good for me will not hold good for someone else,
Right.
right? Because my situation is very different, their situation is very different. So that way, if you see, asset allocation is something which is like an art and a science. It is a science because it is based out on certain rules, certain thumb rules, right? But why is it an art? Because no two people will have the same needs, have the same asset allocation. Every individual will have their own unique needs, own unique requirements, and based on that, we have to do our asset allocation strategy, right? So
Right.
it is something which is very unique to every individual.
Definitely. So if I'm a person, who's a working professional, right? You would have a different allocation for me. And if I am somebody who's about to retire, right, you would have a different allocation for me. So can you explain what
Yeah.
are the ideal mix for different set of risk profiles or different profiles that you guys identify in the market?
Yes. See, here again, as I just said before, asset allocation is something which is very unique to every individual. Let me
Right.
give a simple example. Let me take the two situations. Say one is I've got two friends, Mr. A, Mr. B. Both studied in the same school, did engineering together, passed out, did MBA together, working in the same company, having the same salaries.
Yeah.
Let's say both are 30 years old.
Right.
Mr. A, right? He is married, he has two children, spouse is a homemaker, parents are retired, and they are
Right.
dependent upon Mr. A for income,
Right.
right? And Mr. A has got a house. Obviously, they'll take a housing loan. He's got a car. He's got a vehicle loan.
Yeah.
And Mr. B, same salary. He's married, but spouse is working. Parents are retired, but parents have got a pension income, right? He is staying with his parents. They don't have a housing loan. They just have a car loan.
Right.
So when you say asset allocation, they say the thumb rule is age minus 100 should be equity allocation, right?
Right.
That is the thumb rule. That's what we say. But if I look at this situation, say both are 30-year-olds, right?
Hmm.
But Mr. A, he has got more responsibilities. He has got more liabilities on his head, right? He's the sole earning member. He's got a housing loan. He's got a car loan. His spouse is dependent upon him for income. His children are dependent upon him for income. Parents are dependent upon him for income. Although he's 30 years old, the thumb rule would suggest 70% equity, 30 debt. But since
Yes.
he has got so much responsibilities and so much liabilities, he will be considered as a conservative investor.
Right.
Maybe we will have a 50-50 debt equity or even say a 70 debt 30 equity. It will be the reverse because
Right.
he's a very conservative investor. Whereas Mr. B, he has virtually no liabilities. His parents are self-dependent, spouse is working. His loan is just one small car loan. For him, we can also go up to say a 90% equity if he can
Right.
take that kind of risk, right? So that is one thing. Asset allocation, the first factor which determines what is going to be my asset allocation is my risk taking ability and what are my dependents that I have and what are my
Right.
liabilities,
Right.
right? So that will automatically get covered under the risk taking ability.
Right.
Second and most important is what are my financial needs,
Right.
right? So let me again go back to this example, Mr. A, Mr. B. So we have in our first example what you said, Mr. B has no liabilities on his head, so he can maybe even go up to 90% in equities. But
Right.
say Mr. B has got a financial dream that he wants to buy a house after
Right.
2 years. Say the house is going to cost him 1 crore rupees, right? So the house, out of this 1 crore rupees, he has to pay say 20% upfront. The bank will fund him 80%,
Right.
right? And say today, Mr. A's portfolio is say valued at 50 lakh rupees.
Right.
Mr. B's portfolio, sorry, is valued at 50 lakh rupees, and
Mhm.
he needs 20 lakh rupees after 2 years.
Right.
And since he knows he needs this 20 lakh rupees after 2 years, although he's an aggressive risk taker, I can't have 20 lakh rupees in debt, right? In equity. I have to keep that 20 lakh rupees in debt. So
Right.
automatically say out of 50 lakhs, if my initial say 90% of 50 lakhs is 45 lakhs was equity, 5 lakhs was debt. Now, although he's an aggressive investor, because
Hmm.
he needs 20 lakhs after 2 years, I will have to shift 15 lakhs to debt, right? So now what will
Right.
happen? 20 lakhs, say 25 lakhs in equity, 20 lakhs in debt. Automatically, my asset allocation comes down from 95 5 to say a 40 60, 60 equity,
Right.
40 debt. Why? because he needs the money after 2 years.
Right.
So the second thing when I'm doing my asset allocation is, when do I need this money? That will again determine my asset allocation. Right? If I need more money right now in the next few months, few years, obviously I will take more debt in my portfolio. But if I don't need this money now, I need the money only after 5 years, 7 years, 10 years, then I can take more equity in my portfolio.
Right.
Right?
No, I think
So
that
that is
that makes a lot of sense. So our asset allocation should be a function not just of our age, but also of our, risk-taking
needs,
capability,
financial.
our liabilities that we have, our responsibilities and our goals, right?
Yes. And another thing in asset allocation, before we start asset allocation, there is one very important thing that needs to be done is create an emergency corpus.
Yes.
Right? This emergency corpus should be kept separately aside. Because if you see in the last 2-3 years has taught us the importance of having some sort of money with us, right?
Yeah.
Life is very uncertain, jobs are very uncertain. Last 2 years in COVID has taught us a lot of things
Definitely.
that we need to be financially prepared. And so before we start off at asset allocation, my first thing is I must ensure that I have got money kept with me for emergency. How
Definitely.
much? We normally say that if I'm a salaried individual, at least 6 months of my monthly expense should be kept aside safely. If I'm a
Right.
businessman, I should have minimum 1 year of my income kept aside separately. Then
Definitely.
I start my asset allocation.
Right. Right. And yeah, it matters a lot. Like if somebody is planning to, take a step, right? Let's say somebody is going for entrepreneurship or they want to pursue some hobby as a full-time career, right? So in that case, they need to have a financial backing before they can take all those steps. So I think that's
Definitely.
a great point that you put. Now we've talked about risk a lot, Niranjan. Right? We've said that asset allocation is reducing risk in the portfolio, right? And which is something that we understand, giving this a much more balanced exposure. But I want to understand: does asset allocation also improve returns? Will it give me better returns?
Okay. Here again, let me take a simple example. Say I am from Bombay, right? And I want to go from Bombay to Pune by car. Right? And we know Bombay Pune, the best route is take the expressway, right? So the expressway, suppose say from Bombay I start and I can reach Pune in 4 hours, right? Say 3 hours by the expressway. I have two choices. Either I take, say I am driving a Mercedes Benz. I've got a choice that this is a Mercedes Benz. I know the top speed of the Mercedes Benz is 220 kilometers an hour, right? Until I reach Panvel, maybe my car will not be able to go more than 60, 70 kilometers given the Bombay traffic. But once I hit the expressway, I see an empty road and I have the choice of driving this car at 200 kilometers an hour, right? If I drive the car at 200 kilometers an hour, there's a good chance I will cross the entire expressway and reach Pune, say within a matter of 1 hour. Right? That is one choice. The second choice is I decide to play it a little safe, take the car only at 60 kilometers an hour. It's a Mercedes Benz, but I know, if I go very fast, there's a good chance that I'll get into an accident and die. Right? So I drive the car only at 60 an hour, but then I will reach Pune only after 4 hours. Both the situations, first situation, take the car at 200, reach Pune in 1 hour is also super risky because there's a good chance I lose control, tire bursts, I will die. But if I go at 60 kilometers an hour, I will reach Pune after 4-5 hours. It doesn't make sense, right? So what do? I take the middle route. I drive the car at a constant 120, where I have got full control of the car also, but I will reach Pune in say 2 hours. Right? So that is what asset allocation is, where I am not taking too much risk, but I'm not going zero risk also. I'm taking the middle route. Right? So I have to put the example in numbers. Say I have got an investor A. He is 100% invested in equity. Say the value of his investment is 100 rupees today. And investor B, who has got 70 rupees in equity, 30 rupees in debt. Say for some reason in the next 1 year, the markets have corrected by 50%. Right? And Mr. A's 100 rupees becomes 50 rupees. Whereas Mr. B, the 70 rupees say would have become 35 rupees. But the 30 rupees debt, say, would have gone to 35 rupees.
Right.
So Mr. A has seen a loss from 700 to 50. Mr. B's portfolio has come down from 100 to 70.
Right.
Right? So now the markets have recovered, and say from the market has doubled from here. From say 100 rupees, the market has doubled from here. And Mr. A's portfolio, 50 rupees, would have gone up to say 80 rupees or 90 rupees.
Right.
Whereas Mr. B's portfolio would have gone up from 70 rupees to almost 120 rupees.
Yes.
Right? Why? Because a 50% fall in the market in its value, to recover, he will need more than double returns. Right? So Mr. A, although the market has recovered, but he is still sitting at a loss because his loss was so big that to recover it, his investments had to go more than double. Whereas Mr. B, his portfolio fell only by 30%. Right? And for 30 to recover, it has to go up not more than 60-70%. So basically, when I am doing asset allocation, what I am doing is ensuring that in the bear market, my losses are minimized, so that in a bull market, I'm able to recover faster and generate better returns. Right?
Right.
So see, the objective of asset allocation should be what? Minimize my losses in a bear market, so that in a bull market, I can recover from the losses faster and generate more positive returns.
Right. So
that
because we saved,
asset allocation should be.
Yeah. So we also saved money during bear market, and we were able to, grow in the bull market also because of the right mix of assets. Right. So obviously it has given us a outperformance over the market. So that's a great example. And and I think we can also talk about an event like a black swan event like COVID in this context.
Yes. So if you look at COVID, look at March 2020, it was a bloodshed moment, right? Where the markets all of a sudden in a matter of 1 month just crashed by almost 40-50%. Every asset crashed. Look at equity markets, it fell by 40-50% that time. But at that time, my fixed income market, my GSEC market, government bond market, actually bond market did not crash so much, actually went up. Why? Because people were scared of investing in equities. Where will they invest? In the safer assets, that is debt. Right? So this is where we have got enough live examples where in a market correction, a portfolio which is pure equity portfolio would have actually given much bigger losses as compared to an asset allocation portfolio where my losses were lower. Right? So that is and every investor, they want to get the highest returns.
Right.
But please remember, when I'm chasing returns, I have to accept very high losses, which we don't want. So asset allocation
much better. It's a much better way to, if you don't want to be facing like a black swan event and, have a crisis, it's best to have a balanced mix of assets, right?
Yes. See, we don't know when the black swan event is going to come, right? I cannot be prepared for market corrections. But how I can minimize my losses is through asset allocation. And that is what asset allocation should be, not get the highest returns. My objective of making an asset allocation is minimize my losses.
Definitely.
That is what
Niranjan, so we obviously see there's a lot of benefit to asset allocation, especially during, crisis time. But is there any risk associated with asset allocation that people should be aware of?
Yes, see, asset allocation, when I talk asset allocation, I'm saying invest part in equity, part in debt, part in gold, right? So what happens is sometimes we see that the markets are extremely volatile, right? Sometimes you will see almost a 30-40 market correction in a matter of few months. Right. Say, for example, let us take a situation, say today I create a portfolio, asset allocation, where I'm 70% debt equity, 25% debt, 5% gold. So today I'm a new customer. I have created and I have been advised to create a 70% equity, 25 debt, 5 gold. And I do that. But say for some reason, the markets from this level just go up by 100% in the next 6 months for some reason, just double up equity markets. Then what will happen? My 70 might become 85. So then I will have to book the profits, shift to debt and gold.
Right.
So what happens in an extreme event, within a very short time, asset allocation can go for a toss. Then if I have to rebalance, the tax issues might come up. Right? If suppose I sell equity, I have to pay 16% tax. Or if I sell my debt, I have to pay my marginal tax rate. Right? So and it might result in very frequent churning. So a client might feel that why are we churning my portfolio so quickly? Right? Because and they have to pay higher taxes which can eat into the returns. But this could be the only, I will say, risk. Is that in a very volatile market, my asset allocation might be subject to a lot of churn. That could be perhaps the only risk of asset allocation.
I agree with you there. Now, see, I think we've covered asset allocation in great depth. Like we got a very, very good understanding of asset allocation. We understand what the benefits are, what are the ways in which it gives us better return and how, what are the risks. Now to wrap up, I would like to ask you, what are the products that Axis Bank offers that, investors can utilize for asset allocation?
Okay. Here in Axis Mutual Fund, we have got two products which are very helpful for our diversification tool. The first product which we have is an Axis Triple Advantage Fund, which invests in equities, debt, and gold. Right? So this fund will have up to 65 to 80% in equities and 10 to 20% in debt and gold. So this is a very true blood asset allocation fund because I get all the three assets in the portfolio. The other fund which we have is the Axis Balanced Advantage Fund, where the fund manager, depending upon the market conditions, right, can increase or decrease the equity and debt allocation accordingly. So instead of telling the client to buy and sell equity debt, in Balanced Advantage Fund, we are telling the fund manager to do that job. So in both these funds,
investor also does not have to incur the taxation, right?
Yes, he does not have to incur that extra taxation or the load factor and all that. That is done inside the fund by the fund manager itself.
And in the long term, you look at risky times or good times, the Balanced Advantage tends to have like a balanced sort of a return, right?
Yes. So the Balanced Advantage Fund, the Balanced Advantage Fund, what is the biggest advantage is like what we told, right? See, the objective of my investing is what? Generate decent returns, better than inflation, but in the downside, minimize my loss. Right? And that is what a Balanced Advantage Fund strives to do. In a bull market, I will strive to generate decent returns, right? But the biggest plus or use of a Balanced Advantage Fund is in a bear market, I minimize my losses. And so that is how the Balanced Advantage Fund is positioned.
Definitely. And, good times or bad times will always be there in the market and we have to prepare for both. But we can't only bet for good times or, only for bad times, we have to prepare for both. Perfect.
Yes.
So now, a lot of people come to our channel and they want to know something about the market outlook, Niranjan. So I will, ask you the last question, which is, what is your short-term, long-term outlook over the market and what should be the ideal asset allocation for an investor in this market?
In the short run, the fund house view is that the markets are going to remain volatile because of a lot of factors, like what's happening internationally, what's happening on the US front, on the interest rate side, what is happening with respect to Russia, Ukraine, and all that is going to keep the markets in the short run on tender hooks, right? We're going to see a lot of volatility in the market. That is a given. But if I have to look at a 2-year, 3-year, 5-year perspective, right? Indian markets are extremely well placed to benefit from the growth in the Indian economy, right? In the medium to long run, our equity markets are going to reflect what is going to happen in our economy. And today, it has been established and accepted that India is perhaps one of the few countries in the world of our size to constantly grow, even at 6 to 7% per annum. And given that 3 to 5 year horizon, definitely the markets, we could expect to see better than these levels in the next 3 to 5 years.
That is definitely like everybody is betting on the India growth story, the consumption story, the infrastructure growth.
Yes, definitely.
Yes.
And as I said, on the asset allocation front, as I said before, and I again repeat, asset allocation, every individual will have their own unique asset allocation needs.
Yes.
No two people will have very similar asset allocations. Your
Right.
asset allocation is a factor of first, what is your risk taking ability? Second, what are your liabilities and responsibilities?
Definitely.
Third, what is your need for money?
Definitely.
These are the three factors which will determine your asset allocation strategy.
Right. Right.
Yes.
That's a perfect way to wrap up the discussion. We are all betting on the long-term growth story, and there are going to be some short-term volatility that having a good asset allocation will really help us, in our investment journey, especially in a time like today. So thanks a lot, Niranjan, for coming in to this show. It was a great learning experience for us. We all learned about asset allocation. You explained it to us in very, very simple terms. And I think everybody listening to this session would have understood this concept very clearly.
Thank you, Sonam. My pleasure.
So thank you everyone for joining us. If you want to watch more of such sessions and if you want to follow more such webinars, please do subscribe to our channel and like this video so that you get more such video recommended to you.